All right, welcome to Kruse Asset Management's quarterly webinar with Stuart Kruse, CFA, and John Brick, CFA. Little private joke there. So this is going to be an abridged version because we just did our webinar and we have to re-record it. The recording didn't take. So we're going to get this information out, probably in a little bit of bridge, but if you have any questions, please feel free to follow up. Send us email at info@kruseassetmanagement.com or John at kruseam.com or Stuart at kruseam.com. So let's hop right into this thing. Let's share my screen. Here we go. So we're going to talk a little bit about year-to-date performance first, and John's going to cover that. So take it away, John.
Yeah, so it's been a pretty interesting market. As we know, we're at a little bit of an AI rally. What's interesting, though, is if you look at the performance on this next slide coming, the S&P is up 15.5%. The Qs, the NASDAQ is up 17.5%. So you see a lot of those headlines. But below the surface, there's not a lot of gains being had. If you're an individual stock picker, not a lot of those stocks are keeping up. The international market, as seen here, 5.4%. The bond index, flat, including the dividends, so you're actually losing on the price. And the REIT index is negative 3.7%, interest rate sensitive. Other things not on this chart, the small cap and the mid cap index and the equal weight. So an equal weight S&P return is if you just take all 500 stocks and equal weight them versus what is on the screen here in a market cap weighted. That index is only up around 4.5%. So the same index weighted differently is lower by about 11%, just showing the top heaviness of a few stocks doing the lifting. The mid cap index around 4.5% as well. And if you invested in the small caps, you're actually flat on the year. So the only place to be is owning two tickers, SPY and QQQ right now.
Yeah, typically that equally weighted index outperforms the market cap weighted index like 9 out of 10 years. So the fact that we're so in the opposite direction might suggest there's some sort of regression to the mean at some point.
Yes, sir. I think you have some multiples to show.
Yeah. All right. So let's move on to the multiples, which is indicative of the market outlook, perhaps. So we're going to look at the price, the forward PE ratio. PE stands for price by earnings. That's how much is somebody willing to pay for $1 of earnings as created by an S&P 500 company. It's a good way to equalize, how much earnings a company is making and give a valuation. So the long-term 30-year average for the S&P 500 is 16.6. People are willing to pay $16.6 for every $1 of earnings created in an S&P company. One standard deviation up there is around 20. And you can see we got above one standard deviation during the dot-com boom and during COVID. So in the last 30 years, this doesn't happen very often. Now, this chart is about 90 days old, and really, we're not here, we're here. We're at 22 times. So we're at some very exceptionally expensive areas in the marketplace right now. So what does that mean going forward? Well, this is the same data and says, if we're at a PE of, let's say, 22 times, here's the PEs on this axis, and the next 12-month returns on this other axis, what would be the next 12-month returns? As you can see by these plots, some of these next 12-month returns are fantastic, 40+%. Some of them are really bad, negative 20%. This is a very interesting number. This R squared is, in geek terms, statistician geek terms, is how much relationship is there between the PE ratio and the 1-year returns. 0 means there's no relationship. 100% means it's exactly perfectly correlated. This is 7%. That means almost no relationship. So if you look at this, this is a scatter plot, which looks pretty random. And it says there's almost no relationship between PE ratios and what the next 1-year returns are going to be. So why do we even care? Well, we kind of don't on 1 year. But this is the same data for 5 years, 5-year annualized returns. And as you can see by this pattern, it's much more correlated. And so if we were to look at a 22 ratio, PE ratio there, you're probably looking more along the lines of 5-year annualized returns being the 2, 3, 4% range. So nothing spectacular. And in fact, the best that we've ever seen in the past is probably 6%. So what that really suggests is over the next year, we're going to have some great possible returns and some really bad returns. So a lot of volatility. That means you're going to need to be tactical in order to add value to the marketplace. So which one are we going to be in? Are we going to be in the upside or are we going to be in the downside? Well, momentum tends to work in the stock market, and we're in an election year, and almost all election years are also positive. So momentum's moving to the upside. We have an election year, so we would suggest that momentum would continue to make the market even more expensive. We'll keep an eye on it, but we would suggest that we're going to be in the positive versus the negative. But more likely than not, over the next couple of years, we are going to see some pretty devastating numbers down here. Comments? Mr. Brick.
I think that's well said. And I'll just reiterate that we do have our eye on the markets, looking at the technicals, the momentum, relative strength. And if things do change rapidly and they start breaking down and losing momentum, we will shift. We did that in 2022 very well, and we sidestepped much of the down draw that happened there. And so we're not blind to the risks, but we're also trying to play for those upside scenarios, like Stuart said. And you said in the past about, irrational exuberance by Alan Greenspan, and the market rallied for 3 more years. So we are trying to play the best of both worlds, and we are watching every single day.
Yep. So the economy is still pretty strong as well. We don't really see that many cracks in the economy. That's why, and we're going to talk about this a little later, the Fed has not dropped interest rates because the economy has been so strong. The only real cracks we might see that we're keeping an eye on are flows into early delinquencies. So student loans, they look awesome because of the loan forgiveness program. But if you look at autos and credit card debt, they're moving above their, 10, 15-year average of flows into delinquencies. So not only that, mortgage rates are higher. People are spending more on a daily basis for their mortgages. That cuts into people's purchasing power. The lack of purchasing power caused by delinquencies, higher mortgage rates, should reduce some of the flow into the economy. 70% of the US economy is based off of consumer purchasing. So we will likely see some slowdown. That slowdown is the definition of a reduction and potentially a recession in the marketplace. So this ticking up is not a great sign, but it's one of the few cracks that we see in the economy. But there's nothing imminent that would cause the market to decline anytime soon, that we think. Okay. Next topic, we're going to talk about inflation discussion. John's going to touch on this a little bit.
So inflation has definitely been the number one headline for a lot of people in the last couple of years. This chart goes back to 2015. It has 3 components. The purple chart being the 2-year treasury rate, which is actually the market version. It's what's the supply demand part of the market. The orange is the Fed fund rate, which is what the Federal Open Market Committee actually controls and changes at their meeting. And the blue rate is overlaid, showing the consumer price index year-over-year change, which is the core, the CPI index, which is what everyone quotes when they talk about inflation. So it's never been a problem until, if you look back to the left of 2020, COVID happened. Monetary stimulus picked up in a large way, as did the markets. And you can see consumer price index rose tremendously from 0% to over 9%. But what's included in here was also the Russian invasion of Ukraine, which had a big energy crisis and sparked oil to drive well over 100. I think it topped out at 115. Gas was probably $5 a barrel plus. So you had a bunch of inflation issues. The Fed responded, as you can see, with the orange line, and that has helped put inflation under control. And where we stand now is a very flat, moderating 3 point something percent. which is lower, but not quite where the Fed wants it, down towards our 2% mark. And so we're watching very closely. We're watching the CPI, the components of CPI, mainly oil, and what the Fed will do. So a couple notes on that. The Fed is going to meet 3 more times this year, from my understanding, July, September, and November. I don't think they sneak one in December, but there's tools out there to forecast and see what the Fed's projecting to do. Now, these aren't accurate all the time because they did cut or project 6 cuts before. We said that wasn't going to happen. We were right. We're not always right, just usually. Jokes. So there's almost a 90% chance that the Fed holds the rates where they are now in July coming up. I strongly agree with that. September, there's a 50-50 chance that they hold or cut 25 basis points. I think, given all things considered, there's an election year. That's a very tough one. I probably am going to vote, although it's not going to make a ton of difference. Actually, I shouldn't say that. I vote that they're going to hold, even though it's about a 50-50 chance. A lot of people do think that there's a chance they can actually hike, which is not priced in. And that would be if the CPI that you see here jumps higher and oil prices jump for any reason geopolitically. So anyways, November, which will be after the election, a whole new regime. You cannot price that in no matter what the market says now. Everything's going to change when the new administration's in. Although it is an independent body, it's still part of the process. They believe that there will be a cut. So for what it's worth, rates should tend down. We're watching very closely.
I will put a caveat in here that the reason why the Fed is keeping the interest rate so high, this is the overnight lending rate to banks. They have never been able to successfully fight inflation with the Fed funds rate below the 2-year. So that orange line has to be above the purple line for them to fight inflation. So here, when the purple line was severely above the orange line, that was inflationary pressure that would be going into the marketplace that wouldn't be felt for quite some time. So the Fed raised rates and continued to raise rates to get the orange line above the purple line in order to make them fall. Now, economists have said they needed to drop rates and should have dropped them sooner, but we really don't have that much of a spread between the Fed funds rate and the 2-year, which is disinflationary. So if they drop them too soon and come below that 2-year, it's possible that adds inflation down the road, and we just end up repeating the same errors that we had in the 70s and 80s. And that's exactly what Jerome Powell does not want to do. He wants to make sure that he squashes inflation now when he can. So he said higher for longer. He's looking at the data. And in fact, if this thing starts raising a little bit more, he will have to raise rates. So he's got to keep that orange line above the purple line. That's it.
Well said.
Okay. So now we're going to go into part 2 of our quarterly call. So we're going to try and add some more value as opposed to just talking about what we think is going to happen in the marketplace. So in this case, we're going to talk about the virtual family office and our proactive tax planning. So we've been very strongly moving into this virtual family office. And a family office, for those of you who don't know, is where a family has so much money that they hire a team of professionals just to watch that family's money. So they have a CPA, estate planning lawyer, wealth advisor, private equity guys, a whole payroll. So that can get expensive. So you're usually looking $500 million to $1 billion to actually run your own family office. That's not to say that our clients who may not have $1 billion can't benefit from a team of professionals working together to optimize their financial outlook. And that's exactly what we're trying to do. We bring a team of professionals together to work with your CPA, to work with your estate planning lawyer, to work with other people that might help with your financial picture as a team-based approach, like your insurance person or what have you, to optimize your picture, as opposed to us working against each other. So last year, we started doing this. We've been doing this for the last couple of years. Tax planning is one of those areas that we really focus on. Now, we love our CPAs. They're fantastic. Can't live without them. They sometimes are more backward looking. So they take in your data, they fill out the forms, and are more compliant. They don't often get paid to be more proactive and help you reduce your taxes, even though that might be what you want. If you're paying $100,000 in taxes, you would love for your CPA to give you a bunch of suggestions to bring that down to $50,000 or $25,000. He is not really paid to do that. So we try to step in, provide them with some other strategies and help them be more proactive so that we can help you reduce your tax bill. So John's going to talk about one of a dozen strategies or so that we use, and I'll cover a couple more.
Yeah, so oil and gas is one that we've been using for a while now. We've seen it in action on the tax forms. We've seen the deductions actually hit. We actually went down and visited them and saw their facilities and spoke with management. So we feel very comfortable that this is a product that's durable and sturdy. Oil and gas is needed, in the economy and the AI boom and all the energy that the generative AI needs. I think it's going to be a very interesting place to be for a while. So I guess the bullet points of this, and we can follow up later with any questions, but the bullet points are, as you can see here, is 93% deduction. If you invest $100,000, you get 93% in a form of a tax write-off, directly reducing your W-2 income. It's one of the only strategies. There's a couple, but it's one of the few that can reduce your W-2 income. And the target return, this isn't just a tax strategy. The target return is still like an investment, over 200% expected over the 8 to 10 years. The interesting part about the oil and gas is how plentiful oil reserve is in the early years, meaning as they pump the oil out in plentiful ways, you get more distributions early on. And as a result, earlier cash. Math suggests that the IRR is very high. It's a very high and strong returning product from an IRR standpoint. You should get most of your capital back within 3 to 4 years, including the deduction on your taxes. It could be closer to 2. So I'll leave it there, but it's a very strong product and we endorse it well.
So that's talking about a deduction. So let's say you had $200,000 worth of income and you put $100,000 into this oil and gas. That reduces your income down to $100,000. And instead of maybe if you're at the 40% tax bracket paying $80,000, you're now only paying $40,000. It's still money outlay, but it reduces your income. The other side of this are tax credits, where you get a dollar for dollar credit against any tax liability. So there's a couple of strategies that we were using. One is solar. So every dollar that you might send Uncle Sam, you could send that to a solar investment and buy a solar asset. Now, this isn't going to make you wealthy overnight, but over the next 8 to 10 years, if you were to put $100,000 buying solar assets, you may end up with about $140,000 of return. And that's $100,000 that you would have sent to the government that you just get to now take and turn into a passive income stream. Okay, so that's one thing that we've been doing. And then the second thing, we were just in San Diego, or I was just in San Diego at a virtual family office conference with our group, and we saw dozens of financial professionals and experts talk about different strategies, everything from cash balance plans to tax mitigation strategies. There's one where brought up there was a Native American provision where they are allowed to create tax credits for services rendered. So we had a fund manager come in and say, we are going to provide you with services rendered. Some of it was investing in this oil and gas strategy. And the Native American groups can create these tax credits. So what ends up out the other end is that we can buy $1 worth of tax credits for 60 cents. So if you had a $100,000 tax bill, you can satisfy that tax bill by buying $100,000 worth of tax credits for $60,000. So a 40% discount off the top. It's fantastic, right? So we can stack these different tax strategies, oil and gas and charitable strategies and other leverage strategies on top of these solar credits and then on top of this Native American strategy and really bring your tax bill down. In some cases, we use 3, 4, 5 different strategies for our clients and worked in conjunction with their CPA to really reduce the tax bill from $400,000 down to $100,000, let's just say. The long-term benefits can be pretty substantial, obviously. And we have dozens of these strategies, so they work on W-2 income. Some of them work on W-2, some work on business, some work on passive, non-passive income. So we'd be working to be very proactive for you there. It's all part of our virtual family office. Tax mitigation is somewhat relevant to everybody, but there's also our virtual family office has 70 plus professionals in a wide variety of areas, everywhere from cost segregation strategies to, as I said, cash balance plans, to helping you value your business, to business advisory, anything that you need in finance, we probably have somebody that we can partner with, or we have partnered with, that we can bring in to help you optimize your finances. So kind of next topic, we're going to talk a little bit about alternative investments as well.
Yeah, so as Stuart was mentioning earlier with the expected return of the S&P, we can always find something to do. And I think we pride ourselves on having a full service, full stop family office, as we said. So part of the family offices, if you look at the big family offices that are out there, a lot of the assets that they contribute to are alternatives, and they invest in sports teams and all the cool things. So we have access to a lot of the funds and investments that these guys have. Excuse me. So I want to remind everyone that is what we have. Sorry, I'm choking over here. And so part of those are more evergreen strategies where they sit in your Schwab account, and they do awesome for diversification purposes, and they are a vital part of a portfolio management tool. So in 2022, we saw the markets drop 20 to 30%, but based on the S&P or the Qs, and Qs are the NASDAQ, and our private equity strategies were up about 8% on average. So, we have a lot of ways to sidestep bad markets if we wish, and people who don't like the public markets, we have a lot of alternative solutions. So we have two major platforms that we can go to, and I want to just remind and just, I guess, educate. These are leading consolidators in the industry, and they have slices of major funds that we can go get and have access to. So if you want a single family home fund, or you want Oakmark's distressed credit fund, or you want anything of the sort, chances are we can access it. And so we're trying to highlight more of these, and this is an attempt at doing that. And as we continue to have more conversations, we can highlight more. And I want to just spend the last 2 minutes talking about one interesting one that just popped up. This one is one of the only players in the space that are actually going out into the world and buying minority stakes in major private equity funds. So a lot of people may see KKR bought XYZ, and Blackstone bought, and Thoma Bravo bought, and there's all these other types of funds, private equity, infrastructure, etc. And this fund that we have access to, which you can be in, would be a general partner in these funds. They're going out and using your money to purchase stakes in private equity funds, and so you'd be an owner in one of the most growing, sought after spaces at this time. So the interesting part about the strategy is that the cash is so high, the cash on cash return is so high in your investment that whatever you commit, let's use 100,000 as a round number, you should only be out of pocket max 46%, and that's only for a small amount of time, meaning the cash flow is so high from the investments that your investments are your cash outlay is much less than expected. So you have this tremendous investment, this annuity on private equity, essentially, for very minimal cash outlays. And so just one of the few things that we can highlight, the returns are 20 to 25% expected IRR, and that's expected, not guaranteed. And it's very sought after. So more info if you'd like. Just wanted to share and kind of give some tidbits of some of the things we may do.
Yep. All right, as I said, we're kind of re-recording this, so there's a Q&A session, but we answered the questions on the fly that were presented to us while we were there. And so in conclusion, we are doing all that we can on the asset management side and trying to augment your returns either through structured notes, through private equity, selling options, using tactical strategies to get in and out of the market when we think the market's breaking down or moving forward. And then, as my dad says, it's not how much you make, but how much you keep. So the virtual family office, where we've taken a lot of strides towards building partnerships there with CPAs and with other experts, we're helping really focus on these tax mitigation strategies. We will be addressing them more in the second half of the year, perhaps after these extensions are refiled, so we know where you're at in 2024. We can apply some of these strategies to your 2024 taxes and really bring down your tax liability as well. So John and I spend our days on how to make your portfolio and your wealth more efficient and optimize that. as much as we possibly can. We appreciate your trust in us, and we're working hard to continue to add value every day we can. So from Stuart Kruse and John Brick, thank you again. And this is Kruse Asset Management's quarterly market call, and it's June 27th, 2024. How time flies.
Have a good day.